Over the years, there's been a lot of different popular styles, theories, and charts and patterns and all sorts of stuff looking at stocks and buying and selling stocks. I mean, we have the broad categories of like growth investing and value investing and income investing in these different sectors or different market capitalizations and looking at large cap, small cap, whether by individual stocks or mutual funds. So there's a lot of different ways to invest. From fundamental analysis, looking at this company and its value and its stock prices and all that, to charting, where you don't forget about all that and just look at charts. So a lot of different ways to look at it, and from that have come out different types of theories or ideas or postulated different things that you can do. You can take advantage of and make it kind of real simple. If I just follow this program, I'll be successful. And that's the idea behind some of these kinds of programs. And one of the most famous ones out there is called Dogs of the Dow. What a great name, right? Dogs of the Dow. So you might have heard of it. It's very popular. If you look back data stuff, they've had some success and some not success, but they've had some success. It's all a matter of, well, will they have future success? It's always the million-dollar question, of course, in investing. What's the future? And you can't always rely on the past, because they say past events do not necessarily lead to future results. Our past success doesn't lead to future success. So dogs of the Dow. Let's talk a little bit about dogs of the Dow. So first off, who are these dogs? And what is the Dow? Well, the Dow is the Dow Jones industrial companies from way back when this was established. And basically it was a way to take the 30, not necessarily the largest, but 30 representative U.S. stocks, United States, this is for the United States then, this would be U.S.-based stocks. The Dow is 30 U.S.-based stocks that represent the entire economy. And what was the idea behind it? This goes all the way back to the early industrial age. So you'd have like railroads and Ma Bell or AT&T as a telecommunications first phone company, or General Electric because they made lights and electricity, and mining companies and all the different things that you'd have in there. And you had these 30 companies. Nowadays you have 30 companies, some representing newer technology, as far as the internet and computers and all sorts of stuff in there. But it's still 30 companies that are supposed to represent the broad U.S. economy, from people who make soap to people who make computers, is within these 30 companies. Well, you can probably already see that's not really super representative. That's why you see things like a total stock market index or Fortune or S&P 500 indexes to give you a broad range. But this is the Dow. The Dow Jones Industrial Averages is these 30 companies. So what are the dogs of the Dow? And how does this whole process work? Well, the dogs are the companies that are underperforming of those 30 companies. Which are the underperforming ones? And the idea is you buy every year, it's on a yearly basis, you buy those dogs in the hope that they will be better the following year, the year that you buy them. And then every year you're buying new dogs and you're selling your previous dogs. So every year you're buying and selling. And so what you're looking at is, when you look at this, is you're looking at the dividend yield, right? So with something with a high dividend yield. And why is that? Well, let's remember, dividend yield is the yield. It's basically the percentage that you're going to make on these dividends, like an interest rate might be a way to think of it in comparison. So if I take my dividend price and my stock price and look at those, a higher dividend yield would mean my stock price has come down and my dividends maybe stayed the same or gone up a little bit. So I'm going to have a bigger percentage number. I'm going to have a higher dividend yield when stock prices come down. So if you look at the dogs of these 30 companies, these are companies that maybe their stock has not gone up as fast as the other 30, or maybe they've come down, maybe they've come way down, and you're looking at those 30 bottom dwelling companies. And the idea is you buy those bottom dwellers because you're trying to buy undervalued stocks, though they're great companies. These are 30 large major companies, so they're not small cap, fly by the night companies. These are the major players that everybody would recognize their name. And the idea is that at the end of the year, those stock prices would rise, and then when the next year comes, you look at the bottom 10 again, and you buy those same 10 again, and then you do that over and over, and you outperform the overall market by following this technique is the idea behind dogs of the Dow. And if you have, let's say, a stock that's 2 years in a row, a dog, well, you hang on to it. It's still a dog. You don't sell it until it's out of that bottom 10. So each year you rebalance and you select a new 10. Is the idea behind it. So you got kind of portfolio rebalancing right there. Now you do have some churning. You're buying and selling a lot, so you're incurring those expenses of buying and selling transaction costs, so do be aware of that. But the idea behind it is, hey, if we follow this method, then we don't even have to think about investing. We just buy the bottom 10 of these 30 companies based on dividend yield, and then we'll have success. And they've had success, and something to maybe check out. I would look at a broader range of stocks, because once again, you're narrowed to large. Only 30 stocks is your universe to choose from, versus international and just a tremendous amount of stocks in large, mid, or small cap and all these stocks. But it's a technique you can use to look at. But I would look at the broader one. But if you're interested in dogs and down, go do some more research on it. But that's the idea behind a lot of these kind of programs. Like, if you follow the program, you'll be successful. And all of those can be a little bit dubious, but they got some back success with dogs of the Dow.